They thought the worst was over. They thought yesterday was just another ugly correction. They thought 75 was a quiet place where the market could rest. But markets do not rest when systems are stressed. Yesterday, silver erased billions in paper value in hours. Today, it stopped falling at exactly 75. Not by accident, not by luck. That price was defended hard, violently. And when a floor has to be defended like that, it means something underneath is breaking. Yesterday did not feel like a normal pullback. It felt like the floor dropped out from under the system. Silver did not drift lower. It fell. Fast. Hard. With no hesitation. In a matter of hours, the price collapsed from the highs into a vertical slide that erased billions of dollars in paper value. Not over weeks, not over days, in hours. That alone tells you this was not healthy price discovery. This was forced liquidation. This was not volatility. This was stress. Liquidity was thin. Desks were light. Algorithms were in control. When the first wave of selling hit, stop orders began to trigger. Margin thresholds were breached. Forced selling kicked in. And once that chain reaction starts, price no longer moves because of opinion. It moves because positions must be closed. Gone. Removed. Taken. Retail traders call this panic. Institutions call it a clearing event. The sentiment flipped instantly. One moment. Silver was unstoppable. The next, the same screens were flashing red. Commentators rushed in to declare the bull market dead. Social feeds filled with fear. Fingers hovered over sell buttons. But look closer at the structure of the move. In a true crash, price breaks levels cleanly. It slices through support like it does not exist. It accelerates as fear compounds. Yesterday did not do that. Yes, the drop was violent. But the moment price reached the mid-70 zone, the character changed. The selling slowed, then stalled, then stopped. That is not what capitulation into oblivion looks like. That is what exhaustion looks like. This was a textbook deleveraging flush. Weak hands, overextended longs, late buyers who chased the breakout and could not survive the pullback. They were not selling because they changed their thesis. They were selling because they had no choice. And while that was happening on your screen, something else was happening off screen. Limit orders were waiting. Not above, not below. Exactly where the break happened months ago. The market was not falling freely. It was being pushed into a zone where demand was already mapped. Already measured. Already prepared. This is how strong markets reset. They do not grind sideways politely. They shake. They snap. They scare out the tourists. They test conviction. Yesterday was not the end of the trend. It was the stress test of the structure. And the most important detail is this. The system did not fail. It bent, then it met resistance, and that resistance was 75. What happened at 75 was not buying, it was defense. There is a difference, and that difference matters. Buying is casual. Buying is opportunistic. Buying happens when price drifts into value. Defense happens when a level cannot be lost. Defense happens when the system draws a line and says no further. Yesterday, when silver reached the 75 zone, the price did not bounce gently. It slammed into resistance. The tape changed character. Sellers hit the market and were absorbed instantly. Every push lower was met with size. Not retail size, real size. This was not dip buying. This was structural defense. To understand why, you have to go back months. In November and early December, 75 was not support. It was the ceiling. Every rally died there. Every attempt higher was rejected. Volume built. Frustration built. Pressure built. Then, the breakout happened. And in markets, there is a rule that never dies. Old resistance does not disappear. It transforms. When price finally breaks through a ceiling, that ceiling becomes the floor the entire structure stands on. That is polarity. And polarity is unforgiving. When price came screaming back down yesterday, it did not randomly stop at 75. It returned to the scene of the breakout to test whether that transformation was real or fake. Was 75 just a number? Or was it structural? The answer came fast. If 75 were weak support, price would have sliced through it. Stops would have triggered. Panic would have compounded. Instead, the opposite happened. Volume exploded at the level. Not selling volume, absorption volume. Millions of contracts changed hands in that zone. This is where psychology turns mechanical. The traders who bought the breakout at 75 months ago were suddenly back at their entry. They were not scared. They were relieved. And they defended their ground. At the same time, The traders who sold 75 months ago, who faded the breakout and got trapped, were finally given an exit. They bought to cover, not because they were bullish, because they were wrong. Both sides bought, for different reasons, at the same price. That is how a level becomes fortified. This is why 75 did not crack. It did not even wobble. It absorbed pressure like a shock absorber. You could throw size at it. And it did not move. This was not a price finding buyers. This was a system protecting credibility. Because if 75 fails, the breakout narrative fails. And everyone knows it. Desks know it. Algorithms know it. Funds know it. So they defended it. Not politely, not quietly, but with force. This was not a floor made of hope. This was a floor built from memory, regret, positioning, and size. And when a market shows you that kind of defense, you pay attention. Humans did not stop this drop alone. The machines stepped in. And when machines act, they act with math, not emotion. In modern markets, the majority of volume is executed by algorithms. They do not read headlines. They do not panic. They do not care who is bullish or bearish. They respond to coordinates, levels, ratios, triggers coded long before yesterday ever happened. Silver hit one of those coordinates. If you map the entire rally from the early November lows to the recent highs, the correction stopped exactly where strong markets stop. Not deep, not generous, just enough to reset weak hands. The 23.6% retracement, that level sits just below 75. The market came down hard, fast, inviolate, and then bounced before it even touched the line. That is not coincidence. That is dominance. Weak markets need discounts. They fall to the 38.2 level, sometimes the 50. They need to entice buyers. Strong markets do the opposite. They barely correct at all. Buyers front-run the math because they are afraid of missing the next move. That is exactly what happened here. The algorithms calculated fair value for a shallow pullback. Human capital stepped in early, paid up, and did not wait for perfection. That is how strength expresses itself. Now look at the moving averages. The 20-day average represents the mean price paid over the last month. In a normal reset, price comes back to that line, it breathes, it cools off. Yesterday did not allow that. Silver bottomed well above the 20-day average. This is called front-running the mean. It happens when institutional money is chasing exposure and refuses to risk not getting filled. Funds know that everyone sees the same averages. Everyone waits for the same pullback, so they step higher. They pay the premium. They would rather overpay slightly than miss the trade entirely. This behavior tells you something critical. Demand is not satisfied. Supply is not comfortable. The system cannot afford patience. When price floats above its averages instead of touching them, it signals acceleration, not exhaustion. And this is where many people get it wrong. They see algorithms and assume manipulation. They see math and assume illusion. But algorithms are not inventing demand. They are responding to it. They are amplifying pressure that already exists. Yesterday, the machines did not save silver. They followed the rule book of strong trends. They hit the retracement. They saw the absorption. They confirmed the defense. And they flipped from selling to buying. This is not what markets do before collapsing. This is what they do before resuming. But here's the key point. Machines do not care about narratives. They care about flow. And flow did not disappear at 75. It concentrated, which leads to the next question. If machines followed the math, who provided the size, that answer is not on your chart. While screens were flashing red and retail traders were freezing, the real money was moving, quietly, deliberately, without hesitation. This is where the story shifts from charts to flow. Yesterday, you saw fear. Today, you see ownership transfer. Look at the ETF data. During the collapse, shares were dumped. That was retail panic. Weak hands exiting at the worst possible moment. But as price stabilized near 75, the flow reversed. Net inflows appeared. That is not coincidence. That is rotation. For every seller hitting the market in fear, there was a buyer on the other side with conviction. Institutions do not chase green candles. They wait for stress. They wait for forced selling. They wait for liquidity to appear. Yesterday gave them exactly that. But the most important buyers were not the funds. They were the users. Industrial buyers stepped in with size. The moment price dipped below 76. Solar manufacturers, electronics producers, battery supply chains. These players do not trade momentum. They trade survival. For weeks, they were sidelined as silver ran higher. They could not justify chasing 80-plus prices. Inventory levels tightened. Procurement desks waited. They watched. They planned. When price collapsed into their zone, they acted. This is called the industrial put. It is not written, it is not announced, but it is real. When silver drops to a level where it makes economic sense for factories to restock, they buy everything available. Not futures for leverage, physical exposure, forward contracts, guaranteed supply. They do not ask if price might go lower tomorrow. They ask if they can afford to have zero metal next month. At 75. The answer was clear. At the same time, another quiet shift was happening. The commercial hedgers, the banks and producers who usually lean short to manage inventory risk. They stopped pressing. Open interest stabilized. Some shorts were covered. Ask yourself this. Why would a bank reduce short exposure at 75 if they believed 50 was coming? They would not. They cover because downside is limited. They cover because risk has shifted. This matters. When retail sells, institutions buy. When industry buys, price finds a floor. When commercials stop shorting, pressure releases. All three happened at the same level. This was not a technical bounce fueled by hope. This was a fundamental rejection of lower prices. The ownership of the market changed hands, from leveraged speculators to long-term allocators, from weak hands to entities that need delivery, not just exposure. And once that transfer happens, floors become harder to break, because speculators can change their minds. Algorithms can flip, but factories cannot stop running. That demand does not disappear with headlines. It does not care about sentiment. It sits there, waiting, absorbing, and that is why 75 held. 75 did not hold by accident. It exists because three forces converged at the same time. Remove one, the floor weakens. Remove all three, the structure collapses. Right now, all three are active. The first force is psychology. Markets run on stories as much as numbers. And 75 is not just a price. It is a line in the narrative. For months, it was the barrier silver could not cross. When that barrier finally broke, it redefined the entire regime. Above 75, silver is no longer just an industrial input. It becomes a monetary signal. That is why the defense was so aggressive. Losing 75 would not just mean lower prices, it would mean the breakout was fake. It would mean credibility damage, and traders defend stories harder than they defend trades. This creates a self-reinforcing loop. Buyers step in because they believe other buyers must step in. That belief alone builds size. The second force is risk already priced in. The market did not wake up yesterday surprised. The fears were known: policy deadlines, export restrictions, supply chain stress. None of that was new information. What happened yesterday was the market dumping risk ahead of the event. This is how markets work. They sell the fear before the date, not after. By the time price reached 75, the worst case was already reflected. That changes behavior. Bad news loses its power once it is absorbed. Shock value disappears. Sellers who were afraid have already sold. What remains are buyers waiting for confirmation. At that point, risk flips. What was a headwind becomes fuel. The third force is the hardest one: physical necessity. Industrial demand does not negotiate with sentiment. It does not wait for perfect charts. It responds to inventory math. Factories run on just-in-time systems. When metal is available, they buy later. When availability becomes uncertain, they buy now. Yesterday created that window. At 75, procurement desks saw value. More importantly, they saw urgency. A brief chance to secure supply before rules change, before paperwork slows, before delays ripple through production. This is not speculative demand. This is survival demand. It does not disappear if price dips $1. It does not vanish with a headline. It stays, it absorbs, it builds a base under the market. Put these three together: psychology, defending the story. Risk already priced in, physical demand anchoring price. That combination does not guarantee upside tomorrow, but it explains why downside failed yesterday. This is why 75 did not crack. It was not allowed to. But here's the part most people miss. Floors like this are strong, but they are also loud. They tell you the system is under strain. When a market needs this much force to hold a level, something underneath is tight. This is not calm. This is pressure. And pressure does not resolve sideways forever. Which brings us to the final question. What happens next is no longer just about silver. It is about what hits the system next. 75 held. That much is clear. But do not confuse a defended floor with a quiet market. This is not stability. This is tension. If 75 holds through the next shock, price stops being the story. Delivery becomes the story. Physical demand takes control. Paper loses authority. And if 75 breaks, it will not break gently. Markets do not resolve pressure politely. They resolve it violently. This is no longer about silver going up or down. It is about which system breaks first.